Hello, good day. This is Kingsley Abedi again. So, thank you for joining. Today, I'll be talking about shares, bonds, and mutual funds. So, what are shares? Shares are simply units of ownership of a particular company. So, let's take, for instance, Zenith Bank PLC has 41 billion units of shares. When you buy a particular unit, you're a shareholder. So, let's say you buy 1,000, 10,000, 100,000, 1 million, or 10 million. You are a shareholder, of Zenith Bank PLC. So the advantages of having shares is one, capital appreciation. What do I mean by capital appreciation? When the share price increases, the value of your investment has increased. Then dividend, you can get dividend payment when dividend is declared, maybe interim or final dividend, you get your dividend payment. And of course, if there's a bonus issues, you get your own share of the bonus based on your number of holdings. However, some of the disadvantages of shares is is very, very volatile. Now, so let's talk about bonds. Bonds are usually fixed income instruments. Uh, there are corporate bonds, there are federal government bonds. So for corporate bonds, they are issued by companies, blue chip companies. So they are debt instrument. These companies use to raise funds in terms of debt, and sometimes these bonds, most times they come with fixed interest rates, right? So when the bonds are being released, okay, do you see the interest is being paid back? The interest comes in form of coupons, right? They are being paid back, of course, with the principal. So apart from corporate bonds, we have federal government bonds or state government bonds. These are issued by state government or federal government to raise funds. They are also debt instruments. So these coupons, that's the interest on these bonds, are usually paid to bond owners uh, quarterly. Okay, so then at the end of the maturity period, you get your full value. So the advantages of bonds to individuals, is that it is less risky. It comes with steady coupons. It is less risky, and it is a form of stable investment. However, on the flip side, the potential for growth, or the potential for capital appreciation, the potential for making more money, making more profit from it is very, very slim, because it comes with fixed interest rate, and you cannot get more than the interest rate, unlike shares. Okay, so of course, the advantages of bonds to the issuer, that's the company or the federal government, is that it helps them to raise funds. Okay, for the company, rather than taking loan from banks, you just take loan from the public corporate bond, in terms of corporate bond. Yeah. And for the federal government, rather than printing more money or going to maybe let's say IMF or World Bank, right? They just go to the public. Okay, so that's for bonds.
Talking about mutual fund, let's say there's a particular fund that comprises of investment in stocks, real estate, oil and gas, and if you want to own a unit of ownership, that is mutual fund. That's the
So just
concept of
like
it.
a pool of funds, that are being invested in a particular sector or in several sectors, better put this way. So let's say you have 500 million naira and you invest in uh, real estate companies, you are investing in shares, you are investing in let's say you're investing in bank shares, you're also investing in oil company shares, and all that. So that has made your pool of investment. And the good thing is, an investor, a subscriber, can get also a unit of ownership in this same mutual fund. Okay, so but the advantage of this mutual fund is that it's also less risky. Okay. However, on the flip side, the disadvantage is that the probability of return is not as high as that of shares. Okay, so I believe we learned something today. If you are a first-time subscriber, if you are a first-time viewer, please subscribe to this video. If you are a returning viewer, please like and share this video. And of course, please stay up to date for more quality content. Thank you.